Okay, great. Well, thank you everyone for joining. My name's Chris and I'm on the team here at Planet Tracker. Over the next 30 minutes or so, we'll be diving into our latest work on PFAS litigation, agricultural methane, and comparing four major ag corporates across several factors. And then finally, we'll end with our updated seafood database. So some quick housekeeping before we start. If you have any questions, please do add them into the Q&A box. We'll try and pick them up as we go along here. But in case we can't get back to you on the webinar, we'll reply via email later on. And lastly, we'll be recording this webinar and sharing afterwards. Before we kick off, I just wanted to take a minute or so to introduce Planet Tracker to those of you who are unfamiliar with our work. So Planet Tracker is a sustainable finance think tank focusing on nature-related risks and opportunities. We focus on the drivers of biodiversity loss, specifically land and sea use change, exploitation of natural resources, pollution, and climate change. We provide in-depth research reports on each of these topics, covering a range of industries and themes, as you can see on the slide here. We're not for profit, so everything we do is for the common good, and all of our research is publicly available on our website or on your usual financial data platforms. And with that being said, let's dive into the webinar. So the first topic on the agenda is the latest work on PFAS litigation. And with me, I have my colleague Thalia. So I'll hand over to you. Thank you very much.
Hi, thank you, Chris. Yes, my name is Thalia Bofilio, and I am part of the plastics team. Today, I will present to you the latest analysis from our plastics program, PFAS from non-stick to stack in court. And my main point is that PFAS is not only an environmental health issue, it's an economic liability issue as well. PFAS, often called as forever chemicals, are used across chemicals, firefighting foams, textiles, packaging, and electronics because they have great resistance to water, oil, and heat. However, they are very dangerous because they persist in the environment and build up in our bodies, where long-term exposure is linked to cancers, immune suppression, hormone disruption, and developmental harm. Because PFAS persist, the resulting cause can emerge years later through litigation, remediation, tighter compliance requirements, and pressure on water systems and public budgets. That persistence is what makes PFAS economically distinctive. The liability basically can outlast the original commercial benefit. And that is why we believe that the PFAS risk pattern follows the same with asbestos and tobacco, that they are known for long-tail liabilities. The litigation is already large. PFAS litigation has become one of the biggest environmental mass torts in US history, with more than 15,000 active lawsuits in federal court as of January 2026. And the 3M water system settlement alone was about over 10 billion US dollars, which shows the scale of liabilities now being recognized. And this is not just a US litigation story. The litigation trend in Europe also grows as well. And further, a recent European Commission study suggests that if current PFAS pollution continues to 2050, cumulative societal costs in Europe could reach at least 440 billion euros. Now, Planet Tracker built a PFAS litigation risk dashboard that scores about 1,079 listed companies and 5,248 associate facilities. And the tool is meant to estimate facility level exposure by combining legal case information, regulatory context, emissions, and corporate disclosures. Our analysis shows that this is not an evenly distributed risk. Roughly one-third of high-risk facilities sit within just 20 parent companies. So this, in part, is a concentrated producer problem. But the costs, they do not stay there. Downstream users can still face local contamination claims, remediation costs, and community pressure. That is why earlier disclosure and targeted intervention actually matters. They reduce the risk that costs are simply shifted onto water systems, customers, and communities. Thank you. So as I said, PFAS costs travel downstream, and in order to show that, we looked into two case studies, their litigation exposure, and what this means in financial terms. The first case study is Chemours, an upstream producer with a legacy PFAS exposure. We estimate around $1.1 billion of cumulative PFAS-related charges since 2019, with leaving a current provision of about 360 million at year-end 2025. And PFAS claims are around 17% of its enterprise value. Now, the second case study is Wolverine Worldwide, that they are a footwear manufacturer. Wolverine did not produce PFAS, but it used PFAS-containing treatments in footwear production. And what we saw was their financial exposure was very high, with roughly $160 to $180 million of known settlements and related costs since 2017. PFAS claims are roughly 7 to 11% of enterprise value. So the lesson is that the PFAS risk can travel down the value chain through product use, waste disposal, and legacy site contamination. So what we do recommend is investors should demand a better disclosure on PFAS use, contaminated sites, provisions, and liability estimates, and they should integrate PFAS liabilities directly into valuation, credit, and risk models. Also, they should also use engagement and voting to push for phase-out plans, stronger due diligence, and capital expenditure that aligns with the PFAS limited future. Our takeaway is that if action is delayed, costs tend to be shifted into clean up water systems and legal liability, so earlier visibility and earlier action are likely to be cheaper than later action. And that's from me. Thank you.
Very efficient. Thank you, Thalia. So the next topic is on that we're going to discuss today is our agricultural methane work. So with me is my colleague Ailish, and I'll hand over to you. Thank you very much.
Thanks so much, Chris. Yeah, I'm Ailish, and I'm an associate analyst here at Planet Tracker on the Food and Land Use team, and I'm going to be talking about methane emissions and the roles banks play. So methane is responsible for around half a degree of global warming today, and over a 20-year period, it's more than 80 times more potent as CO2, and that makes it one of the fastest levers we have to slow near-term warming. And the problem is that agriculture, particularly meat, dairy, and rice, accounts for 40% of global methane emissions, and banks are heavily exposed in this sector. So the 25 banks analysed in this report provide around $159 billion in financing to just 15 major agricultural companies. But despite this exposure, methane is almost entirely missing from banking strategies. So we have a situation where high impact climate issue is effectively invisible in financial decision making. So what does the analysis show? First, the scale of exposure is significant. Across just 15 large meat, dairy, and rice companies, the 25 banks analysed are linked to around 1.3 million tonnes of methane emissions every year. And importantly, these emissions are highly concentrated in a small number of very large agribusiness companies. So this isn't just a diffuse or hard to address problem. It's relatively concentrated and therefore actionable. But despite that, the policy response from banks is extremely limited. So to start with, none of the 25 banks have set explicit methane reduction targets, and only 2 banks have any form of agricultural specific targets at all. And even those are partial and don't directly address methane as a standalone issue. One of the most important findings is how banks measure their emissions and where that measurements falls short. So banks provide finance in 2 main ways: direct lending and facilitating finance through capital markets, so bond issuance. And in this sector, about 96% of the total financing comes through those bonds, which are facilitated rather than directly financed. So most banks only include financed emissions in their climate targets, and that they exclude facilitated emissions almost entirely. So this creates a major blind spot. It means banks can continue to arrange large volumes of financing for high emitting companies without those emissions showing up in their targets or disclosures. And in effect, a large part of their real world impact is invisible. In addition to that, many banks also rely entirely on engagement strategies. So they encourage clients to transition to or improve, but there are very few clear consequences if those clients fail to act. So only one bank even mentions withdrawing finance, and that's as a last resort. There's also a significant data and disclosure gap. So most methane emissions in agriculture don't occur at the company level. They happen upstream at the farm level. And that means they fall under scope 3 emissions, which are harder to measure. But those scope 3 emissions make up for most of the total footprint, and yet they're poorly reported and consistently measured and often excluded from targets altogether. Um, so when you combine all of these factors, missing methane targets, exclusion of facilitation emissions, weak enforcement mechanisms, you end up with a system that significantly underestimates both the climate impact and the financial risk exposure. And that's really the key takeaway. The risk is not just environmental, it's being mispriced and under-recognized across the banking sector. So, what should banks do differently? First, they need to explicitly recognize methane as a material finance risk, not just an ESG issue, but something that affects regulation and long term value. Second, they need to set clear quantitative targets aligned with global goals, specifically the global methane pledge of a 30% reduction in methane by 2030. And these should be absolute targets, not just intensity based. Third, banks must expand their scope. So that means including both financed and facilitated emissions and covering full scope 1, 2, and 3 emissions. They should set stronger expectations for clients, requiring methane reduction plans, better disclosures, and measurable progress. Fifth, they need to use financial levers, and that means linking lending to performance, restricting finances where needed, and ultimately exiting clients that are not transitioning. And finally, transparency and accountability are key. So better disclosure, regular reporting, and board level oversight. So in short, methane is one of the fastest ways to slow climate change, but right now the banking sector is not using that lever. And that's it from me.
That's great. Thank you very much, Ailish. Next, we are going to turn to my colleague Richard to discuss, to stay on the agricultural theme and to look at the upcoming research. We're going to produce that reviews four major ag companies. So, Richard, over to you.
Yeah, thanks, Chris. Yes, I'm going to talk about four reports we've published assessing the climate transition progress of Syngenta Group, Corteva, Nutrien, and Mosaic. Now, as Ailish presented, agriculture is an important source of emissions, and thus corporates in the sector can play an important role in global emission reduction. And in our view, investors have a key role in holding management teams to account for their climate targets and the progress they display against those targets. Now, our climate transition analysis work aims to provide investors with the ability to assess transition leaders and laggards using a structured, evidence-based framework, which we are expanding to cover more and more sectors. And Planet Tracker, as I mentioned, has published a series of these company-specific deep dives along with summary reports across a number of sectors, which include chemicals and FMCG. And for instance, we also recently published a summary report on the advertising sector, which built on the individual company analyses, which I talked about on the fourth quarter webinar. So what did we do with this work? Well, as I mentioned, our CTA analysis examined each of Syngenta Group, Corteva, Nutrien, and Mosaic. And the companies range from those focusing on fertilizers to crop protection. And we examined them along a number of different metrics, including emission history, trajectory, policy and engagement, governance, risk management, and capital allocation. The reports are specific to each company. Now, I encourage you to take a look at the reports for company-specific detail. But on this slide, I draw together some high-level common themes. Now, first, we need better transparency on Scope 3 emissions. Two companies, Syngenta Group and Nutrien, do not report Scope 3 emissions at all. And where Scope 3 is reported, there is inconsistency in what categories of emissions are included, making it hard to compare performance across corporates. Secondly, in general, all of the companies need to provide more detail on the strategies they're going to employ to reduce emissions, both in the future and currently, and the costs this will involve. Alongside this, we call for better reporting of their assessment of the risks and opportunities that climate change offers to their business. It might be they need new products that will be in demand as climate changes, or that can help farmers offset emissions, but we just don't get a lot of detail of that at the moment. Finally, importantly, on both customer and supplier engagement, the companies analysed generally provide little detail what they're doing. All the companies seem to be similarly placed in terms of having a developing strategy in this area. That's probably the best way to being quite kind to them, I suppose. And we see this as particularly important given the emissions are typically associated with this sector are in that sort of product use phase. So customer engagement is really critical if they're going to address their overall footprint. So what do we recommend? Now, our recommendations address the gaps I highlighted on the previous slide. Notably, we call for investors to push for clear Scope 3 reporting from all companies with consistent framework used and consistent categories included. This should be associated with Scope 3 reduction target setting and clear strategies for delivering those targets. This should ideally include a detail of the investment needed and timelines for delivery. Finally, we believe that incentivizing management to deliver emission reduction is important. We call for emission reduction targets to be a clear, material part of management compensation setting. And with that, I'll hand back to Chris.
Perfect. Thank you so much, Richard. And last but not least, I'm going to hand over to my colleague Francois to discuss our updated, new and improved seafood database. Thank you very much.
Thank you, Chris, and hello, everyone. My name is Francois Monnier, and I'm in charge of the nature research at Planet Tracker. If you followed our work, you might be aware already of our seafood database. So apologies if the beginning of what I'm going to say sounds like a broken record, but I promise there's something new. So our seafood database is basically a tool to estimate seafood sustainability risk, which I'm going to tell you a little bit about in the next minute. Thank you, Chris. So the reason why we initially built that tool was, I think in 2022 now, where there was a complete lack of corporate-specific seafood sustainability data. It's something that was really painful to aggregate. It's something that was effectively hard to find, but at the same time, a key driver of financial performance, because illegal fishing or overfishing do translate into risk for your financials. So at the time, we put together a seafood database that we originally called the Seafood Database, which covered first 100 and then 300 companies across the seafood supply chain, both listed and non-listed. Most of them are seafood-specific company, but you also have companies like Nestlé or Mitsubishi or Marubeni, which are very large conglomerates for which seafood is a small part of the business, but yet in absolute terms, seafood is really, they are still big players in the seafood industry. And what we did was to investigate the sourcing of all of these companies, which species and which geography. And based on that, we estimated the different seafood-specific risks attached to every company, from overfishing to habitat destruction to illegal fishing, etc., etc. That's something that's been we think, but obviously we're biased, quite popular because it's been viewed more than 15,000 times on our website. And it allowed investors to to identify companies exposed to the risk that I mentioned. But what it didn't do is to assess what companies are actually doing. So in the next slide, Chris, please, I will show you what's actually new in this new release. So that's a little, in theory, you should have now a little video playing of navigation through the website, which shows you now a new functionality, which is a portfolio assessment function. So here, if we, let's say I mentioned Nestlé before, so let's add Nestlé, and imagine you're an investor and this is your portfolio. That's all fictive portfolio, obviously. And by the way, we can't see what you do. So there's no privacy concern here. No matter what you put here, we can't see what the user does. What this new functionality allows is to identify, thanks to a traffic light system, quite simply to to find out what are the key risks in my portfolio, basically where is red, where is orange, and to therefore allow you to refine your engagement and to prioritize it based on the topic or the company. You can see here more details on how your portfolio performs against our benchmark of 300 companies and also how different companies are faring. So let's say now you would like to actually zoom in on one company specifically. Let's pick a Japanese one because Japanese and Chinese company tend to underperform. Kyokuyo is a listed company in Japan. With our new sustainability assessment here, you can see on the right, we've rated each company on 6 different criteria: transparency, fishing practice, compliance, etc., etc. There is an elaborate methodology behind this, and that we're happy to discuss if needed. And that's also very important. At the bottom, you could see here that we show the likely species and countries. There's also a tab where you can see more of that methodology that is called User Guide. And also at the top here, you will see also a tab that is called Findings, which summarize our analysis of what we found when we explored these 300 companies. I'm going to give you a little bit of an overview now of these findings on the next slide, but I encourage you to read more because there's some interesting insights here. So what have we found? Out of 300 company, only 26 were rated good overall. What I mean by that is when we look at all the 6 criteria here that you can see on the bar chart here from left to right, and then if we do a simple average of the score, only 26 companies are overall rated good, which shows simplicity in our scoring system. So good, average, poor. Initially, we came up with something much more elaborate, but eventually it increased the level of subjective decisions that we had to make. So that's why we kept this relatively simple. You have the list of these companies on the finding tabs of our website. I encourage you to have a look, but there you probably won't find any major surprise here in the names. At the opposite end of the spectrum, you have about 136, or exactly 136 companies rated poor that we encourage investors to prioritize in their engagement. And by theme, what I've been looking at the seafood sector for 6 years now, one thing that personally surprised me is how poorly overall the sector is performing on fishing, what we call fishing practices. And by that, I mean to what extent the gear that you use are negatively impacting the environment, what level of bycatch, i.e. Non-target species, are you catching? Do you report on that? What about ghost fishing, etc., etc. So that's something that overall the sector is not doing very well. There are exceptions, by the way. Some companies are publishing this data very frequently. They're publishing it and it's low. So it's not something that is impossible, but we think that's something key. The next one is also transparency. Transparency is also relatively concerning still, even though it's improving. So what do we recommend investors to do? Is effectively to engage companies so that they disclose more. Here you can see on what specifically. So that they also source seafood only from fisheries that are scientifically assessed, well managed, and not overfished. And the equivalent on the farming side, on the aquaculture side. And also to have clear policy against IUU fishing, but also to support best practices. In the findings tab of the seafood database, you see for every topic the name of some companies that we believe are following good practices. And of course, we also want companies to invest in traceability and reduce their environmental impact overall. So that was a helicopter summary of the seafood database. We're happy to discuss more if you're interested. Thank you.
That's great. Thank you so much, Francois. And that does bring us to the end of the webinar. I'll be leaving it open just in case you want to jot down the email addresses of the speakers, or if you'd like to pop a question into the Q&A box and we can get back to it at a later date. But yeah, thank you for your time, and we hope this is useful.